Hello and welcome to Morningstar. I'm Emma Wall and I'm joined today to give his 3 stock picks by Richard Buxton, manager of the Old Mutual UK Alpha Fund. Hello Richard.
Morning.
So what's the first stock today?
HSBC. This is a very sort of stodgy, boring, large cap stock, but firstly it's a dollar stock, and with sterling weakening you're getting automatic upgrades to profit forecasts from HSBC. Secondly, it's financial, and as we begin to see that perhaps the bond bull market has come to an end after 30 years, gilt yields are just slightly starting to move upwards. A positive move upwards in interest rates, particularly in the US, will be hugely beneficial to the profitability of someone like HSBC.
Now, HSBC is a financial and it is a UK domiciled financial. There's a lot of uncertainty around financials, as you well know yourself, post-Brexit. How much do you have to take that into consideration when choosing to invest in HSBC?
Very much, but I think the shares, until very recently, because of the currency movement, financials have been very unloved. They are under-owned, and I think they're pretty cheap. We met the finance director recently. We're extremely confident that the very attractive dividend yield is going to be maintained. There's a number of analysts who still suspect it will be cut. So you've got a very reassuring degree of support from the yield coming through from the stock, and because they are very exposed clearly to faster growing markets like Asia, I think you can take a lot of comfort from owning that stock.
And what's the second stock today?
Tesco. Now, 5 years ago I sold Tesco, 5-6 years ago, after many years of ownership. We know there was a sort of slow motion car crash for a number of years, but I bought back into it last year. I think that Dave Lewis, the new chief executive, ex-Unilever, has acknowledged it's going to be a 5-year process turning this business around, but recent results have clearly shown that it's beginning to work. All the actions that he's taking, they're beginning to attract customers back, and they're spending a bit more money, and they are still far away the largest player in what is a very crowded UK market. So although we fully accept it's still an incredibly competitive industry and the discounters are here and they're not going away, I do think that slowly, incrementally, he will be able to turn that business around, and that will be rewarding for shareholders.
Now, Tesco was a dividend darling. However, it's cut its dividend following the expenses scandal. Not expenses, accounting rather. Yeah. Do you see Tesco being in a position to reinstate that dividend anytime soon? Not
anytime soon. If they did do something, it would be remarkably token, because they still have quite a lot of debt on the balance sheet. And they'd rather, be honest, spend the money buying in some of the leases on stores that they sold in previous years, buy them back and own them, and avoid some of the very onerous rental increases and so on. So no dividend from them anytime soon, but if you've got your HSBC, you'll have a nice yield there. But I think it's still a good 2-3 years to go before they can really get back to a level of profitability where you will start to see a resumption of dividends.
And what's the third and final stock?
Merlin Entertainments. Now, this is a worldwide business, but listed in London, that owns theme parks and attractions, which is a fabulous long-term structural growth industry. They partner with Legoland to build all the Legoland parks around the world. It's not a cheap share, because the market does recognise the quality of the long-term franchise. But they've suffered a little bit this year, because, bizarre to recall now, but the pound was actually stronger against the euro. So they suffered from more Britons holidaying abroad, fewer visitors to the UK, and London is quite an important centre for them. But clearly next year the reverse will apply. There may well be many Brits who end up concluding they'll holiday in the UK, so go to the UK attractions, and conversely there'll be many more visitors coming to London from overseas. So that's a kind of short-term fillip for the next 12 months to what is a very good long-term story.
And how concentrated in the UK is it? Because, of course, there is still a slight threat of recession post-Brexit. And with stocks that are too domestically focused, that is something to be concerned about, isn't it?
It is. I think the UK economy will gradually decelerate, and it is going to be quite sluggish. But as I say, with a company like Merlin, you know, it's so driven by overseas visitors to London in particular, that whilst, you know, its other attractions in the UK are important, it's far more offset by, you know, people coming to the London Eye and so on and so forth. So I think they're pretty well hedged against consumer weakness in the UK.
Richard, thank you very much.
Not at all.
This is Emma Wall for Morningstar. Thank you for watching.